Our next guest says this week's retail sales data and the minutes from the FOMC could reinforce the soft landing narrative and support stocks. Joining us this morning, iCapital Chief Investment Strategist Anastasia Amoroso. Great to have you back. So you're looking for maybe some momentum to build this week?
Look, I am. I mean, we've had a bit of consolidation in the S&P, but we certainly had a pullback in tech stocks. And we just heard this from the New York Fed results, and I think we're going to hear from retail sales and FOMC. The soft landing is sort of the narrative of the land here. And I do expect retail sales to come in pretty strong because, look, consumers have a paycheck that is greater than it was last year. And in real terms, year over year, wage growth is actually running at plus 1.2%. So that's positive for retail spending. And then we've got the FOMC minutes on Wednesday, which I think will reinforce that the committee is likely wanting to pause. And, I think that's the message that we'll hear. So you put two and two together, that should soothe the market nerves once again around soft landing. So unless we get a spike meaningfully higher in rates this week, which we've come a long way in a short period of time, so I don't think we will do that. So I think the main narrative this week will be this soft landing.
Any good explanations as to why we can't get some suppression on yields despite the inflows back to 4.2? Bill Gross on Friday saying fair values 4.5 on the 10-year. Why do you think that is?
Oh, there's so many explanations, to be honest. I mean, it's a perfect storm for rates to move higher here. First of all, you've got better than expected growth. So that continues to support yields, move them higher. Then you've got worries about Bank of Japan for the last several weeks. So that pressures it higher, too. Then you've got inflation. I know we just heard that inflation expectations are working their way back down. But actually, if you start to look at inflation potentially further out in the year, the headline numbers may head higher. So we are concerned about that. And then you've got this, widening gap, which is our budget deficit that we have to finance. And the issuance steps up from 2.3 trillion to 3 trillion next year. So you put all that together with market technicals, meaning a lot of investors actually piled into bonds. And now they're having to unwind some of that. So I think that's why we get these knee-jerk reactions of yields going higher. But again, having said that, we've come a long way in a short period of time. And, it's natural to have some sort of pause of consolidation. And so I suspect we can have that this week.
Interesting. You mentioned, obviously, the knee-jerk reactions that we've seen so far this summer, especially in yields. Here we are now. We're in the last 2 weeks of August, notably, less liquidity typically during the month of August as people take their vacations and so forth. Are you expecting to see additional volatility, at least in the near term?
Look, I think if I'm wrong on the rates move, and if rates do continue to move higher, then absolutely we're going into a very illiquid time period. And we're sitting, we're teetering in this very key, 50-day moving average thresholds on the S&P, as well as some of the key CTA short-term thresholds. So if we break below that, about 44.27 on the S&P, I certainly can't see more of a risk unwind. But what I would say is if that happens, I would use that to your advantage if you're a longer-term investor. And for example, if you look at semiconductor stocks, the S&P has pulled back, yes, but semiconductors have actually pulled back more. They're down about 9% from their recent peaks. So I would use any sort of weakness to be accumulating names that a lot of investors probably wish they've owned all year, which is AI-related stocks, including some of those semiconductors.